Head across to Peter McGuire, CEO at XM.com. Peter, good morning and welcome to the show. Overall, if you go to see the kind of statements that we have heard from Trump, the US-China trade war, the kind of tariffs that he's looking at in terms of China is not only having an impact on the equity market, but yes, some bit of an impact is, percolating even in terms of crude. What's the sense that you're picking up?
Well, good morning, Hiral. Yeah, there's no doubt. I mean, the volatility is demonstrated, as you mentioned just previously, as far as the VIX. I've got to say that some of those markets have been relatively flat over the last, say 12 to 15 hours. Asia's a different bag, but, some of those are well down in today's trade. China's down, of course, and then you've got Japan down the best part of 1.2% also. The Australian market's, holding steady and it hasn't had a sell-off. But I think that there's the issue at hand is what's going to happen as far as the Chinese entering Washington and what transpires today in those talks. And is President Trump going to stay with that, with his stance as far as rolling out those tariff increases from tomorrow?
Absolutely. If those do kick in from tomorrow and there is no last minute deal, Peter, what does this do for the market action then? Because, the last time there was this trade war, last time there was a hike in tariff, there was some retaliation from China. You did see markets react negatively, but since then there's been a very sharp recovery. And up until the build-up of this fresh round of trade wars, US markets were at an all-time high. Now that we've corrected, we're possibly digesting this news coming in, maybe a couple of more days of volatility coming in. What happens after that?
Well, two quick things, Deepanshu. First off, I think you've got to appreciate that the Chinese market's down about 12.5% in the last 3 weeks. Now, that's a heavy washout. And traders have got to be mindful of that. You now got the best part of, 3,600 versus what you had as 4,100. So that's a huge sell-off. The next part is, and that's only in a short period of time, we all understand how quickly those markets ramped up from Christmas, really the start of January onwards. That first 3 months was just extraordinary. And taking that on consideration also is that I feel as though that you've probably got further downside dependent upon what happens with President Trump. And there is no doubt you'll probably see a continuation to the softness of the markets over the next couple of trading sessions. And then what happens as far as the washout, if Trump really doesn't get some form of satisfaction from the Chinese counterparts.
Right. So, Peter, overall, we've been talking about tariffs that, US is going to impose on China. And simultaneously, you have China, which is coming in and saying that we will retaliate. We will also do something similar. If that's going to be the situation, what's going to be the impact on the trade between the different countries? With that, you have Brexit uncertainty also, which is still an overhang. And FIs have started to pull out from the Indian markets. Where do you think they are going to park their money from here on?
And then you've got the next part as far as those warships, US warships entering Iran, as far as the crude coming from Iran and what Iran's retaliation is going to be to those economic sanctions. And you've got also the unknown, which is an ongoing saga as far as North Korea, which seems to have settled down a little bit. Now they're firing, or testing weapons again. So everything in the world is really starting to ramp up now in that Northern Hemisphere summer. And I feel as though the next 3 months are going to be crucial because I can't see there being a lot of stabilisation to the markets. I think volatility, and you'll, again, I think go through the same phase as what you experienced in October, November last year and some of September, those wild volatile swings. And this is a perfect storm. If you look at this, you've seen the VIX up. It's up 50, 60% in the last week. So that's some sort of consideration as far as volatility priced into options. And I feel as though that these are going to be the hallmarks of the rest of May. And who knows what can happen in June or July. So I think volatility and markets are going to be very, very whipsawing as far as opportunity.
Point taken, Peter. Just a word on India fund flows as well. I mean, it's the month of May. We've seen some outflows for the Indian markets. We've corrected about 400 points on the Nifty as well. But if the tensions remain between US and China, could India be actually one of the beneficiaries as far as FI perspective towards EMs is concerned?
Well, you would think so. I think, we all understand as far as the footprint, as far as where China is, but more importantly, India's growth targets over the next 5 to 20 years are going to be electric. And we all understand and appreciate, the big upside potential of the nation. So that storyline hasn't changed, and the opportunities there are as good as, well, you're in the sweet spot. And the sweet spot's going to continue as, you know, you've got a young population. All of the ingredients India's doing right, and they could capitalise from these trade talks, and it could be a very strong boost. And we don't know what is going to be the end game of this. But I feel as though that India's not in a bad position. It's probably in a good position to take advantage of these changing dynamics.
Overall, Peter, what's the sense that you're picking up with regards to crude Brent? We are now below the $70 per barrel mark. A couple of things that are actually, hovering around with regards to where crude prices go, because if you talk about yesterday's session as well, we've seen a marginal drop. The concerns over escalating trade between the US and China is having a bearing. The global supply that has been tightened by the US sanctions on OPEC members, that's Venezuela and Iran, is having a bearing as well. And the ballooning US crude stocks is capping oil prices. Taking all of this into consideration, what is the level we should be tracking?
Well, if you're looking at, this Northern Hemisphere summer, you would traditionally see larger, price spikes. And I think there's probably just some form of washout because the market was so heavily pushed to the upside again since that post-Christmas rally. And some of that heat's coming out of the market. There's probably further, I think, softness for maybe Brent and WTI in the short term. But I think, how it runs into June and July, there are, again, moving parts that need to be considered with OPEC, what's happening as far as the trade talks, and where do these sanctions hit as far as, Iran. So I think one thing for sure, it's very hard to put a price limit as far as where you see crude because you could quite easily be out $10. But I think that volatility and the whipsawing of the markets are going to be very, very strong over the matter of the next couple of weeks. So you could see a market down $3 in 2 days and then up $4 over a week. And that's the issue at hand. It's very hard to quantify what these moves will represent as far as dollar price targets.